Since mid-February, the US Nasdaq has taken a bit of a nosedive, and this has shaken the confidence among several retail investors. But what does this mean, and is there really reason to worry? Since mid-February, the US Nasdaq has gone down, and not necessarily by too much, but rather quite steeply. We've especially seen certain individual stocks go down by quite a lot. Tesla minus 40%, Amazon minus 16%, Apple minus 19%, NIO minus 50%, and so on. This has led to some concern amongst retail investors. But how bad is this really? What can we expect from this, and is this the real crash in the making? This is exactly what we'll discuss in this episode, and as the US Nasdaq is much of a leading index, it'll be our target of focus. But first and as always, nothing in this episode is financial advice. These are my own opinions and conclusions only, as the markets all come down to probabilities. In this sense, just because we may successfully identify the most likely outcomes, the market can still end up doing the unlikely and the unexpected. And if this episode helps you better understand the situation at hand, then please return the favor by hitting the like and subscribe buttons. Let's now dig into the technicals. So, is this it then? Well, I'm gonna give you one answer now and another at the end. The first answer is short and you're not gonna like it. The answer is no one knows. No one knows where the peak is until afterwards. Sure, people might get lucky and sell at the very peak, but there's no way of knowing when the peak is in. For technical analysis is gaming theory and probabilities at work. However, the thing that sets good analysts apart from the unknowing herd is that they can identify such reversals much earlier. And for that reason, they can enjoy a massive advantage compared to that of the dumb money, as they can release their long positions or short the market. For there are several clues that will or may materialize to any attentive trader or technician who has done their homework properly. And out of all those clues, the RSI is the most reliable one whenever it decides to bless us with signals. With that said, we will now look at some key technicals that will reveal whether there's reason to worry or not, and most importantly, why. Now, a big problem that many technicians have, especially novice ones, is that they simply fail to zoom out. For even if you're trading the 1 or 4 hour chart, you still need to know what the prevalent trend is, as in the direction of the primary and secular trends. If you don't, then any drops on the lower timeframes may come across as if Armageddon and the Kraken monster had a baby together.
Death!
Dada!
Domination!
In this sense, if we look at the US Nasdaq on the weekly chart, I quite frankly don't get what the fuss and panic is all about. For what's so worrying about this? It's a perfectly healthy trend. Strong trends correct before proceeding higher, just like crashes have their most temporary rays of optimism before diving deeper. For when we break things down, what's practically happened here is that the price has retested its previous all-time high zone from above as support. That's it.
That's the end of the story.
And to add to the current bullishness, we can see how the price rapidly found support and bounced off at this zone. Now, don't get me wrong, for I can understand why people may find this move unpleasant, especially due to the steepness thereof, for so too would I a few years back. But that's why you proceed to fill your head with valuable market behavior knowledge and an essential technical understanding. For once you do, you understand what's happening. Then and only then can you sit back amidst the false chaos and take a sip of your soda pop while watching the noobs run around with fire in their hair. And once you understand the market and its behaviors, it doesn't matter whether it goes up or down, you'll be getting the best of it either way. And this is why I recommend you to follow this channel, so that you too can learn how to stay in control. Let's now filter all the chart noise and identify and isolate the actual signals. If we stay on the weekly Nasdaq chart, we can make a rather significant observation. Throughout this 12-year-long bull run, only one single correction has taken out a lower low that wasn't just a new spike low. And that was during the Christmas of 2018. Even the Corona bottom closed where the previous local bottom spiked out, which technically qualifies for a horizontal support and not a lower low. And prior to that, throughout this vast trend, we can detect in numerous accounts of when the price has retested the previous tops as support from above. And as just mentioned, this is not a cause for panic, it's a sign of health. This is exactly the stuff we want to see before moving higher, for this right here is the market's way of exhaling and catching its breath. What would be worrying on the other hand would be if the price were to just go up, up and up. That would be like running a marathon at full sprint capacity. You wouldn't get far until your heart gives up on you. In this sense, these moves here since the Corona bottom last year are utterly normal corrections. I would go as far as to say that the US Nasdaq can go as low as the previous local bottoms at around 10,700 and still be perfectly healthy. Sure, that would scare the living hell out of most market participants, retailers in particular, but that's what the market does. It's in its very programming. Instead, that's in fact where you should look at scaling in longs, albeit with a tight stop loss. And there are 3 technical reasons for this. Please allow me to explain. First of all, and as we can see, any time throughout this 12-year-long bull run, any break below the EMA ribbon so far amounted to wonderful buy opportunities where the market has rubber banded itself back up again. Now, don't get me wrong, for at some point the US Nasdaq will go below these ribbons and not recover for many years to come, but this is where technical analysis is all about assessing probabilities and laying a big jigsaw puzzle. For what has every EMA ribbon break had in common historically? That is, apart from one. What they have in common is that they haven't taken out their previous local bottoms. In this sense, the 2018 Christmas plunge was certainly a technical cause for worry. And I would go as far as to say that it wasn't back to bullish again until at this point here. Secondly, the weekly EMA 50 lingers like a river at around $11,500. This in itself amounts to a strong technical support when dealing with secular trends. With that said, it doesn't mean it necessarily needs to bounce exactly on the line, for if we look at its historical behavior, it has died beneath this on multiple occasions throughout this bull trend, and each and every time it has found its way back up again. What this means is that there is technical leeway, for even though there's a good chance it may bounce on that line precisely, it can move under for short periods of times without necessarily having breached it technically. Of course, any retest from below is always a critical moment, however so far it has not failed to do so once in 12 years. But my point here is that a test or temporary breach of the EMA 50 won't mean much as long as the safety net at 10,700 holds up. And thirdly, we have a big, nice green Ichimoku cloud that supports this very level. And if we examine this entire trend, the price has, just as with the EMA 50, never managed to stay below it for any significant time at all of which rather have amounted to strong buying opportunities. Instead, whenever we've interacted with the green Kumos, the price has nicely respected it. By that token, the 10,700 area is a strong yet very critical one. Any break below it would not only plunge us below the ribbons, weekly EMA 50 and green Ichimoku, they would also take out a new local low. And that on its own could be a strong indication of a secular trend reversal. However, in any such event, I doubt the US Nasdaq would just throw itself straight down into the abyss. Instead, I'd rather be looking at a retest at the 11,900 to 12,300 area. And this I'd expect for 2 reasons. First of all, it would be a nice bounce for the market to lull unassuming sheep into a sense of false security. A "the worst is over now" type of denial. For that's typically how the market acts before proceeding with the real plummet. Secondly, this area would constitute a strong resistance zone for all the reasons just outlined. That area would then equate to a shorting area of interest. But let's get back to the core analysis, for this here is getting a bit ahead of ourselves. The reason why I bring this up at all is to let you into my technical reasoning, as the same principle will apply at any point from here on. So let's look at it this way. If we proceed to make higher highs, which statistically and technically speaking is the most likely scenario, then we will establish new critical areas. Hence, if we by the same logic were to move to 15,000 bucks, then this area right here at 12,300 would be the new critical area of interest, at which any break below it would be an indication of a possible secular trend reversal. Are you following? Of course, having said this, we'd ideally be given RSI shorting signals way in advance and way closer to the very peak. If this were to play out, then it would come across as nothing short of magical to anyone who's oblivious to these techniques. And in any such case, they'll be our little secret. Now, some technicians may raise the issue about the 3-point RSI divergence on the weekly that stretches back to pre-corona, and the 3-point divergence on the monthly that has now been broken. But as anyone knows who's watched the RSI trilogy, an RSI divergence in itself doesn't really mean anything at all. They happen all the time. No, a divergence is only interesting and relevant in relation to its technical context. From December 2013 until August 2015, we had a 1.5 year long RSI divergence, yet the price proceeded higher without much ado. On a final note, so far this trend looks perfectly healthy from a technical point of view. But don't be fooled, for fundamentally it's all a house of cards that's waiting to come crashing down. So how then about that second answer that I promised you? The one about whether this is it. Well, in that sense, my answer is no, I don't think it is. And there are two reasons for this, one psychological and one technical. The short psychological reason is that the market doesn't end when people expect it to. It's just much too sadistic and conniving for that. Instead, it will bide its time like a crocodile in the Nile who strikes when the prey least expects it. And so too will the market. Now, the technical reason is that it's pretty much an isolated event on the US Nasdaq. For look at the S&P 500, you can barely tell from the weekly chart that it has corrected. And that's for the simple reason that it's gone down by a ridiculous 5.5%, as in nothing. And looking at the overall technical picture, I can detect no weakness whatsoever. And if we look at the German DAX or the Swedish OMXS30, they're both trading at new all-time highs and haven't bothered at all about following the correctional suit of the US Nasdaq. Hence, this correction in Nasdaq rather tells me it's a sector-related correction rather than a market-wide one. And given how much further ahead the US Nasdaq index is compared to any other index, this minor correction was way overdue. If anything, we've just begun our parabolic craze, and it's likely gonna be with us for some time to come. With that said, it doesn't mean it can't get stormy. Corrections during euphoric moves can be particularly dramatic. All I'm saying is that the skies are nice and sunny for now. To sum this episode up, the secular trend is still intact, and until the technicals turn sour in accordance to the levels we've discussed, we have no reason whatsoever of going against the prevalent trend, which is up. With that said, it will eventually pay to keep an eye on the fire exit, for the fire that's coming will burn most retail investors to ashes. I'll leave you with these words: when the markets start to shake from turbulence and volatility, zoom out. That's where you'll find your answers. That was all for now. Thank you and goodbye.